We have Sanjay Parekh now joining us, founder and CIO at Sohum Asset Managers. Sanjay, good to have you with us here. Good afternoon. Thanks for joining in. We're starting the show a little early because of the 1.5% cut, and good to see you here on the program. So, earnings, I think, are the, we can talk about all which is happening in the world, and a lot is and a lot will happen this week. But here, locally, earnings have been the problem.
Yes.
In your assessment, in your portfolio universe, Sanjay, what has the earnings season really meant? How many stocks have seen earnings downgrades? Where have you seen any upgrades at all? Go on.
Right. So thank you, Prashant. So essentially, yes, earnings season has not been great. While the previews came out, you did realize that this will be a quarter which will be having low growth. Maybe 3 to 4% was the initial expectation, but we may end up with even flattish or negative growth rate. Now, the key point is that, is it more of a one-quarter phenomenon or maybe one more quarter and then we revive, or it's going to be a secular longer-term phenomenon? So, globally, as you know, if there are secular downgrades, then certainly it's not well taken well by the FIIs. But as we see and as we went through our portfolio also, of course, we, right from autos, where we had an exposure, there were downgrades. And then financial was better. It was as per expectation. In fact, financials would look, banks in particular, look better when the whole result season is out. Capital goods is yet to come out for all the numbers. Pharma was broadly neutralish. IT was as expected, lower growth. I mean, a little bit of recovery that we saw. And then, cap goods, I told you, logistics is broadly going to be in line. So cement, of course, we had underweight, and it did help us because we got an underweight earlier. And I think still that will take a quarter or more. So overall earnings, this is an environment wherein you really need to even protect your capital. And of course, then look for appreciation. And, ours is a large cap fund with 73-74% large cap. And luckily, in the last month of fall, markets fell 6.1, we fell 4.1, 4.2. So it did get vindicated. And that's what exactly our positioning, that we would still feel that large cap would look better than mid cap. And mid cap, there is still selectively, there's still froth in certain segments of mid and small cap.
All right. Hi, Sanjay. Good afternoon and good to see you. And as always, what about you're sitting at around 8% cash? You plan on deploying it, or do you think a couple of big cues coming up, US election, Maharashtra election, what the Fed's going to do next, earnings disappointment, you rather sit on that cash, or will you start gradually deploying?
So Nigel, now what we'll do is, and now see, you will not get great bargains and great news. You will get good bargains when there is uncertainty. And here within Nifty or larger caps also, now the good part is your shopping list is getting extended. So now is the time you'll enjoy to buy. You will have more choice. You have to be selective. And our strategy is in larger caps. Let's be into companies where reasonable valuations are there. You have fair certainty of earnings growth rate. And, as overall prospects look better. So you have choice now within Nifty as well. Even in our portfolio, we have 16 stocks in Nifty. So we don't own 34 stocks in Nifty, despite 73% large cap. And we do find that in the next 200-300 points of fall, it will give an opportunity, and one should buy in and increase the allocation to equity. You can have some portion left out for if there's any panic. But we are clearly telling our clients that now accelerate your equity inflows, particularly towards the large cap mandates. And that's a very strong view that we have. But having said that, it's not going to be overnight shooting back, because earnings will be downgraded. Our earnings this year will be maybe 1,060, 70. Next year on 25, 26 will be more like 1,200 now. So at 1,200, if we give 20 times, it's 24,000. But why we think positive is because all the balance sheets are still in very good shape. I mean, barring some microfinance or credit card issue, I think we've never seen all our balance sheets being so strong. And that is leading us to optimism that you need to preempt a little bit early and then start buying.
Okay, all right. Cut that out of the way. So you believe it's a good time to gradually start deploying, as you all have been indicated to your clients. Now,
Yes.
one theme that could play out in the second half of the year is the government spending could pick up. You know, and
Yes.
they are seeing signs of that, particularly in the last 1 month or so. And you've
Right.
been quite positive on the infra space. L&T's numbers actually were very good, and you all have some exposure out there. But not just that, even the second drug kind of companies, you'll have good amount of exposure. Tell us about this theme. How positive are you from here on?
So Nigel, we are positive. So we saw, the order book being slow, and then first year capex spend of government itself is -4%. But clearly, we believe that government, for them to even in their agenda of revival in infra, they certainly will move up on spend, and that's going to be a priority. So we were always overweight there. Only thing is, what we have done is we bought them at reasonable valuation. So, Larsen and Toubro is a big overweight, which helped us. InterArc was a recent listing. It's really was a reasonable valued company, and we saw it almost 25% up in the last 2 months, and we still own it. We've reduced a bit, but otherwise we own it. And then we have, Solar Wilson, we still like, because of a huge opportunity there. And then one company in infra space where we think it's a very deep value, which had survived the past cycle and can genuinely, create value in the next 2-3 years is the Bilcon. So this is where we are, and we believe that, we are well poised in that sector for earnings appreciation.
Got it. Sanjay, hi. Great to have you in with us this afternoon. I'm looking at the IT exposure that you have, and here also you're playing it via large cap names like an Infosys, and there's, I think, an HCL Tech that I can see over here. So what's the read-through, and what is your expectation? Because the companies are still sort of talking about lackluster, mid-single digit to maybe, high single-digit growth. No one's talking more than that. Then there are global majors like Capgemini. It cut its guidance again, and there was so much of panic in the market on Thursday, right, last week.
Yeah.
So what are you baking in? Is this just a tactical move from a safety point of view to large cap IT? Or are you expecting sort of more growth ahead? And what will the US election mean? I mean, will it have a bearing, whether it's Trump or Harris? Could it have any impact on the fortunes for the larger IT players?
I think the last one I'll just take. I think genuinely this US election will be a non-issue for us. I mean, we'll have some coverage and most of it, but I think it's a non-event for us broadly, as I understand. On IT, we've been consistently underweight in the last 2.5 years since we started. It helped us for the first 2 years. In the last 3 months, we did cut our underweight. But in the last run that you saw 30-35% rise in certain stocks, it did hit us. But we realized that, and we did not, we cut our underweight, but we're still underweight there because they're great return ratios are very good, but growth rates are going to be 4 to 5 to 6%. And still we have uncertainty ahead, in terms of US spend, whether it will pick up or whether it will pick up this year or next year. And hence we were not comfortable at 25-30 times. So we were positioned with an underweight, but they do act as a defensive as well. So what we'll do is at a point of time, if we feel that the price is right, we will increase our exposure to IT. That's our stand right now. Okay,
Sanjay, I'm going to throw an open-ended question to you, right? You said you won't find certainty and a great price. So you'll have to sort of venture and wade into some uncertainty.
Yes.
So 2-3 names, just as and with clear disclosure, not an inducement to buy or anything of that sort. What's looking good right now?
So I'll tell you, let's take an example of Maruti, right? Maruti from the peak has reacted 15-18%. And we added, let me be, that's a disclosure that now in the next 2-3 months, you could have, they have reduced their inventory base. The growth rate is 4%. That's all known, right? But can it prolong for next 1, 2, 3 years? I don't think so, the broad story of spend, consumer spend, disposable surplus remains. So here is where, there is not great news, but a great company with some weakness around the SUV positioning. But otherwise, an impeccable, the way they manage it company in terms of cost, capital cost, efficiency is phenomenal. So few corrections of the new good launches, their positioning in SUV getting better, and then you get a bargain, So this is where I think a lot of places, financials have now caught up to the underperformance it had. And in this fall, they've behaved quite well. But even still, I feel there is still, you get the best of the businesses. And we have all larger 4 names, Axis, ICICI, SBI, and HDFC Bank, all 6.5%, and 25%. And that, I think, again, is quite good. So we will now get a lot of ideas, I think. And that's where it excites us now, that in this fall, even if cement, while last quarter was weak, third quarter is again weak. But if the larger names were to get it 5-7% lower, we will positively look at it.
I get your point, Sanjay.
Yes.
Yeah, I think hearing you, it's become very clear that you're happy that at least price points are coming to, good levels, lucrative levels. And then you just have to wait for the news flow to start turning around and pick the right company where the news flow turns positive the first, right? But I just want to go back to that point on autos, Maruti. And I thought that was really interesting because now almost 9% of your portfolio is geared towards autos. And the news flow is really negative, barring a Mahindra and Mahindra. It's all downbeat, and maybe some two-wheeler stocks. So just tell us a little more. Why did you pick a Maruti and not, say, a Hyundai, which you can also play now? And on two-wheelers as well, today's market is very interesting because Hero actually had good numbers, but the stock is getting sold off. Within auto, what are the other new additions beyond Maruti? And what are you really playing for here?
As you can see in the portfolio, Sansera is a holding that we own for 1 year. It's went up. Samvardhan and Motherson is again 2.5 times. We still hold on. We've reduced our weight, but we'll keep this as a core holding. So those are, one of them is a global play, which could have some issues in the interim, but we genuinely like that on a secular basis for next 3-5 years. Now comes the Mahindra has been an existing holding for us. It's worked very, very well. You saw, their EV launch plan. Overall, they've gained market share. In a tough markets, they've done quite well. That is where we are. Maruti, I told you, we just increased as a contra bet. And Hero is one where it's not worked for us. We bought at higher levels. And it was reasonably valued, very well poised, moving up on in terms of their value chain, getting into EV also. It has stayed through Ether. It has an NBFC, and then moving up on the premium positioning. So they're doing all the right things. And we found them at a reasonable valuation, but recently it's been hammered and it's not worked for us. But we are very, very positive again on this name. So overall, I think for the valuation as a basket and for the pedigree of the companies that we own, we are very comfortable to own these companies.
Okay. All right. Good conversation and some very interesting ideas over there as well. Thanks for joining in, and we look forward to the next conversation. Thank you very much for being with us. So that's a view coming in on the market.